Now, moving on in terms of, while I spoke about the macro construct of the portfolio, we'll go into the dynamics of one of the levers of how we think about the market, which is from the view of earnings. Now, any market valuation that you give, according to us, comes from what we call as rate of change of ROE. You can call it as rate of change of earnings, but the issue with just using earnings is an earnings growth does not mean it has to accrete to ROE growth, which because ROE has an element of a certain element of capital allocation from the business that's important to study. And hence, when an earnings growth translates into an ROE expansion, that results in a business giving you structural IRR. Now, if you look at the history of large caps in India over the last 15 to 80 plus years, what you would see is over the last 4 years, where India has gone through what I would call as a structural bull market, you would see a growth of ROE expanding over time. And there are two ways to look at this number. In the previous bull market, where people obviously look at history in terms of studying markets, the ROE back in the day, in the previous bull market, was a lot higher than today. Do I think that we can go into those ROEs? It's going to be a lot harder because as the base effect goes higher, it also means from a percentage perspective, your growth will normalize. But can the ROE expand from here? It certainly has room to expand from here. So end of the day, what you are seeing in terms of growth has come through because of ROE expansion. Now, if this growth in terms of IRR comes only because of PE re-rating, that's where you can call the market expensive or cheap. So before we go into how we think about valuation, purely from an earnings perspective, just if you look at the trend of large caps, you would see a positive base effect accruing in terms of large caps over the last 4 years. One of the reasons India had a poor decade between 2010 to 2020 is where Nifty CAGR at 7.5% over close to 11 years is because of the structural decline in ROEs. So end of the day, from a longer term perspective, you want this number to go higher or stabilize at this range if you have to generate IRRs. Now, the same thing if you look at it from a mid-cap perspective, right? So again, you will see a very similar trend where mid-caps too have expanded their ROEs. However, the difference in this case is the multiple expansion that you have got has been roughly 1.5 times alongside the ROE growth. So in terms of expansion of actual valuations, mid-caps have given you much higher IRRs over the last 4 years for the incremental ROE that has accrued into this particular space. So end of the day, here again, I don't believe that you can go back to a 24 to 25% structural ROE that you saw back in 2007. But there is selective room for ROE expansion that again comes from bottom-up stock picking. But as a space, if you look at it, it certainly is not cheap. And finally, in terms of small cap. So while even if you look at the September flows from Amphi that was released, this flows into small caps continues to be extremely strong. But from a fundamental perspective, over the last 4 years, while ROE has expanded, the justification of PE re-rating has been a lot higher in this space. And if you think about it, the differential between what you saw in 2007 versus what you're seeing in 24 is not very high in this space. So while people can continue to drive momentum in this particular space, the risk reward wise, you don't have a lot of room for ROE expansion from here. So here again, while one can be stocks selective in terms of how you want to position yourself, completely going overweight just because you're getting monthly returns is not prudent risk management. And I think studying this ROE profile of companies over time, because end of the day, some of the best companies, depending on the sector, will go through ROE mean reversion over time. So looking at a structural ROE expansion over 5-6 years without understanding history may not give you the right risk reward at any point of time. Now that we've just gone through the earnings lens in terms of why ROE matters, we'll just look at it from a liquidity perspective, right? So obviously, pretty much people are now very well aware that SIP in the markets is now structural. The trend is real. I still remember when we started the fund, that number was roughly around 4,500 crores per month. Today, that same number is crossing 23,000 crores per month. I'm talking about the gross number. The net number is a lot lower, but the gross number as we speak. And one of the things that I continue to maintain, I think FII into India, I don't think they're coming back in a hurry. I know it is counter consensus, but again, I don't see the need for them to come back to India aggressively. And Asia is transitioning into a space where domestics are going to control the flow of money. Because if you look at FIIs, considering the way US is performing, there is a lot of capital that is going back into the US. So MF as a percentage of FIAUM, I think this trend is only going to increase. And I don't think it's a bad sign per se, where domestics continue to have the lion's share of the overall market. But it also means that understanding the nature of the domestic investor becomes extremely important. Because it's not like an FII money is long-term, domestic money is short-term. I don't think that narrative is also right. But everyone is worried about FI outflows, and I think that is important to track because that has ramifications of which sectors money is going to get taken out of and which sectors money is getting invested in. So as we speak, counterintuitively, what I'm talking about from a risk management perspective is to be positioned in large caps and get underweight small caps. But if you look at the flow of money, it's the reverse. So why I am talking about the reverse is predominantly from a risk reward, looking into the future perspective. I don't think ROE expansion, assuming that it will continue into the small cap space, is a sensible thing across the board. Here again, if I look at it from translating the same number that was in chart, if you look at it from a financial year perspective, every year in the last 3 years, this is only the secondary market. So obviously people can break down data how they want basis convenience, but it's important to realize there are two trends of FPI flows. One is what you get from the secondary market and one is what you get from the primary market. The 1 year FII inflows was positive was FY 23-24. The reason it was positive, though I have shown a negative number, is that inflow went only into the primary markets. So FIIs are using positioning more so from a tactical primary market perspective, and structurally getting underweight, not underweight, but taking outflows from India. Whereas DIIs, if you look at it, that trend has been extremely strong. And I would not expect this trend to reverse anytime soon. Finally, in terms of the third lens that I was talking about, when growth is strong, like I said, 4 years, whether you look at large caps or mid caps or small caps, the top 500 companies have shown you structural ROE expansion. When ROE expands, you also don't expect the market to be cheap, which is what this particular chart says. So if you assume that rough mean P for what you call as the large cap market is roughly close to around 18. If you look at over a 22-year trend of India, you are at 1 standard deviation above mean. Mid and small caps are more like 2 to 2.2 standard deviations away from the mean. So from a relative risk reward perspective, while liquidity can drive additional deviation from the mean, you are getting into a territory where bottom-up stock picking and positioning in the right sectors becomes increasingly important from here. So while returns was the only thing that you looked at so far, I think risk-adjusted returns is going to become increasingly important from here. So two things that we are cognizant of. One, how do we not sacrifice liquidity? And rather than just saying that because market is a touch expensive away from the mean, so it has to correct. I'm not sure that's a wise thing to say either, because I don't think anyone can give you a timeline around when it has to correct. So two things that are going to determine this: the next few quarters, how earnings pan out, alongside next few quarters, how the liquidity in terms of the domestic market pans out. And this could induce some amount of volatility, though from a structural perspective, I think it is a long-term, very bullish sign. From near-term perspective, positioning portfolios where you don't sacrifice liquidity becomes increasingly important.